It was a Sunday morning in Dallas, Texas. Open house signs were planted across the street, but something felt off. A couple years ago, you would have seen cars lined up, people
They need an
walking
answer
in and
by
out,
5 p.m.
agents
today.
rushing
Best and final.
conversations,
Okay,
buyers
get
trying
Darren
to
on the phone
outbid
right
each
now,
other
and
before
we
the
need to
day
submit
even
our
ended.
highest offer
But
immediately.
now, the street was quiet. Just a few people walking through slowly, taking their time, asking more questions than making decisions. Inside one of those houses, a guy named Ryan stood in the kitchen, hands in his pockets, looking around like he was trying to convince himself this made sense. On paper, he was doing well. Stable job, decent income, good credit. A few years ago, he would have easily bought a place like this without thinking twice. But now, something didn't feel right. Not about the house, but about the numbers. He opened his phone and looked at the estimated monthly payment again, and that's where the real story begins. Because the housing market in 2026 isn't about home prices the way people think it is. It's about the monthly cost of owning. Back in 2020, 2021, rates were low enough that even high home prices felt manageable. People weren't buying homes, they were buying monthly payments. And those payments felt affordable, which created demand, which pushed prices even higher. It became a
Now,
cycle
last
driven by
chance.
cheap
I'll pay
money and
cash.
urgency. Everyone was trying to get in before it
Get
got
out of my
worse.
way. I want that.
But now, that entire equation has changed. Ryan noticed that even though this house wasn't priced much higher than similar homes a few years ago, the monthly payment was significantly more expensive. Same house, different math. And that difference is what's confusing people across the country. Because when people hear housing market, they think in terms of price, but what actually drives behavior is affordability. And affordability is a combination of price, interest rates, taxes, and income. In 2026, that combination doesn't feel comfortable for most buyers. This creates a strange situation. Sellers don't want to drop prices significantly because they remember what homes were worth recently. Buyers don't want to jump in because the monthly payments feel too high, and when both sides hesitate, the market slows down. Ryan walked through the rest of the house, but his mind wasn't on the layout anymore. It was on the commitment. Because buying a home isn't just a transaction, it's a long-term decision. And when the numbers feel off, people hesitate. That hesitation is happening everywhere right now. Not a crash, not a boom, but a pause. And pauses are uncomfortable because they don't give clear signals. People don't know whether to wait, buy, or stay out completely. This is where psychology takes over. When the market was rising fast, people feared missing out. Now, people fear overpaying, and those are two completely different emotions that create completely different behaviors. Ryan didn't make an offer that day, not because he couldn't afford it, but because he wasn't convinced it was the right move. And that's the shift happening in 2026. Buyers are no longer reacting emotionally. They're questioning the math. And when buyers start questioning the math, the market changes. If you're watching this and feeling confused about what's actually happening, you're not alone. Because from the outside, it looks mixed. Prices aren't crashing, but they're not rising fast either. Homes are selling, but slower, and everything feels uncertain. If you want to actually understand what's going on and what it means for you, make sure you like, subscribe, and join Andrew Finance. Because in the next part, we're going deeper into the real math behind this market and why it feels stuck right now.
Ryan went home that day without making an offer, but the question stayed in his head. Not should I buy this house, but why does this feel so off? Because on paper, nothing looked broken. Prices hadn't collapsed, the economy was still moving, people were still buying homes. But when he sat down and really looked at the numbers, he started seeing what most people were missing. It wasn't the price that changed everything. It was the cost of borrowing. He pulled up a simple mortgage calculator and compared the same house across two different timelines. In 2021, with low interest rates, that house might have cost him around $1,800 a month. In 2026, with higher rates, that same house was pushing closer to $2,800 or even $3,000, depending on taxes and insurance. That's a massive difference, not in price, but in affordability. And this is the 2026 math no one explains clearly. Even if home prices stay the same, higher interest rates make homes feel significantly more expensive. So buyers don't care that prices haven't crashed, they care that the monthly payment is harder to justify. Now multiply that across millions of people. This is where the market starts to feel stuck, because sellers are anchored to past prices. They remember what their neighbor sold for in 2021 or 2022, and they don't want to accept less unless they absolutely have to. At the same time, buyers are anchored to monthly payments, and those payments don't make sense at current rates. So what happens? A gap forms. Homes sit on the market longer. Sellers start making small price cuts, not huge ones, just enough to test demand. Buyers keep watching, waiting for either prices to drop more or rates to come down. And this waiting game slows everything down. Ryan noticed something else too. Inventory was slowly building in his area, not flooding the market, but increasing enough to give buyers more options. And more options mean less urgency. When you have time to think, you don't rush decisions. And when buyers stop rushing, sellers lose leverage. But here's where it gets interesting. Even with more inventory and slower sales, prices weren't crashing the way people expected, and that confused a lot of people. Because in most markets, when demand drops, prices fall. But housing in 2026 isn't behaving like a normal market, and the reason comes down to something most people overlook. Supply is still limited. A huge number of homeowners are locked into low interest rates from previous years. They're sitting on mortgages at 2.5% or 3%, and selling would mean giving that up for a much higher rate, so they're not moving unless they absolutely have to. And that keeps supply tight, even when demand weakens. So now you have this unusual situation. Demand is weaker because affordability is lower, supply is restricted because people don't want to sell, and the result is a slow, stubborn market that doesn't move quickly in either direction. Ryan started realizing that waiting for a crash might not be realistic, because this isn't a typical bubble scenario where everything collapses fast. It's more like pressure building slowly, with small adjustments over time. At the same time, another factor was quietly affecting everything: income. Even though wages had increased in some areas, they hadn't kept up with the combined impact of home prices and higher rates, so the gap between what people earn and what homes cost remained wide, and that gap is what keeps affordability tight. This is why the market feels confusing, because different pieces are moving in different directions. Prices are sticky, rates are high, incomes are lagging, and behavior is changing. Ryan stopped looking for a simple answer after that. He realized the market wasn't broken, it was transitioning, moving from a fast, emotional market driven by cheap money to a slower, more calculated market driven by affordability. And that transition feels uncomfortable because it removes certainty. There's no clear signal telling you what to do, no obvious buy now or wait answer. If you're watching this and trying to figure out your next move, this is the part that matters. Not predicting what the market will do, but understanding how the math affects your situation. Make sure you like, subscribe, and join Andrew Finance, because in the final part, we're going to break down what this actually means for you and how to move smart in a market that doesn't behave the way people expect.
Ryan stopped trying to predict the market after that. Not because he didn't care, but because he realized something most people take too long to understand. The housing market isn't something you figure out perfectly. It's something you position yourself for based on your own situation. A few weeks later, he went to another open house. Similar price range, similar neighborhood, but the experience felt completely different from what people used to talk about. The agent wasn't rushing him. There was no pressure to make an offer immediately. In fact, the agent even mentioned that the seller had already reduced the price once and was open to negotiation. That would have been unthinkable a few years ago. And that's when it clicked for Ryan.
The advantage in 2026 isn't timing the bottom, it's having leverage. Because when the market slows down, power shifts slightly toward the buyer. Not completely, not in a dramatic way, but enough to matter. You can ask questions, you can negotiate, you can take time. And time is one of the most valuable things you can have when making a decision this big. But here's the part that really matters. Just because you can buy doesn't mean you should. Ryan sat down later that night and looked at his finances honestly, not based on what the market was doing, but based on what he could actually handle. He ran the numbers again, monthly payment, property taxes, insurance, maintenance, everything included. And then he asks himself a simple question. If nothing improves for the next few years, can I live with this comfortably? That question matters more than any headline. Because the biggest risk in 2026 isn't buying at the wrong time, it's stretching yourself too thin in a market that doesn't give you margin. High monthly payments leave very little room for error, and when something unexpected happens, job change, medical expense, economic slowdown, that lack of margin turns into pressure fast. At the same time, waiting forever isn't the answer either, because trying to perfectly time interest rates or home prices is a losing game. There will always be uncertainty. Rates might drop, but prices could rise again. Prices might fall slightly, but rates could stay high. There's no clean, perfect entry point. So Ryan changed his approach completely. Instead of asking, is this the best time to buy, he started asking, is this the right decision for my life right now? And that shift removed a lot of confusion. He focused on things he could control: his income stability, his savings, his ability to handle the payment without stress, how long he planned to stay in the home. Because in a market like this, your personal situation matters more than the market itself. He also understood something deeper about the 2026 math. It's not just about what you pay today, it's about flexibility. If rates drop in the future, you might be able to refinance and lower your payment. But if you buy something you can barely afford now, you're betting on the future to fix your present, and that's a risky position. On the other hand, if you buy within your comfort zone, even if the market doesn't improve quickly, you're stable, and stability gives you options. Ryan eventually made a move, but not out of urgency or fear. He negotiated a better deal than he would have gotten a few years ago, chose a home that fit his budget comfortably, and accepted that the market wasn't perfect. But his decision didn't depend on perfection, it depended on control. Looking back, the market didn't feel chaotic anymore. It felt slower, more calculated, more realistic. And that's why so many people are confused right now. Because we got used to extreme conditions, fast growth, easy money, quick decisions. And now that things have normalized in a different way, it feels uncertain. So when people ask, what the F is happening to the housing market, the answer isn't dramatic. Nothing is broken. The market is adjusting to reality. Higher borrowing costs, slower demand, limited supply, and more cautious buyers. It's not a crash, it's not a boom, it's a reset. And in a reset, the people who win aren't the fastest or the most aggressive. They're the ones who understand the math and make decisions based on their own situation, not the noise around them. If this helped you see the housing market more clearly, make sure you like, subscribe, and join Andrew Finance. Because here, we break down real money decisions in a way that actually makes sense for your life, so you don't just follow the market, you move smarter within it.
If this video opened your eyes, make sure you subscribe, because what you learn today can save your future tomorrow.